All right, let's dig into the latest earnings for U.S. global investors, ticker GOAU. Now, this is an interesting one. On the surface, you've got this story of innovation, bold strategies, and a pivot to the future. But when you look underneath at the actual numbers, they're telling a much tougher story. So what's the real deal here? Let's break it down. And this really gets to the heart of the problem for anyone looking at GOAU right now. You've got management betting the entire company on this pivot into these highly specialized ETFs. But at the same time, the financial results are just flashing red all over the place. So is this some brilliant, forward-thinking move that the market just doesn't get yet? Or is the market right to be cautious?
Okay, first up, let's just look at the top-line results for the fiscal year. And, there's really no way to sugarcoat this. It was a tough one. So operating revenue came in at $8.5 million for the year. That is a massive 23% drop from last year. And the main reason for that? A really big decline in their assets under management, which for a company like this is their absolute lifeblood. Well, that drop in revenue, it hit the bottom line, and it hit it hard. The result was a full-year loss of 3 cents per share. Now, to give you some perspective, just last year, they actually earned a profit of 9 cents per share. Swinging from a solid profit to a loss like that is always a major red flag for investors. For any asset manager, the key metric you've got to watch is assets under management, or AUM. It's the engine that drives all their revenue. For GOAU, average AUM fell all the way to $1.4 billion. That's a staggering $500 million drop from the $1.9 billion they were managing just 12 months ago. So you put it all together on one table, and the trend is it's undeniable. Revenue, earnings, AUM, every single key metric went in the wrong direction. They literally flipped a $1.3 million profit into a $300,000 loss. So with numbers this bleak, what's management's story? How are they trying to spin this? And that brings us to what management is saying. They're trying really hard to shift the focus away from these pretty awful results and get you to look at their big plan for the future, something they're calling the Smart Beta 2.0 pivot. This quote from CEO Frank Holmes is really the key to understanding their entire philosophy. They see themselves as macro investors. They're looking at the big picture, trying to get ahead of major government and economic shifts, and then create products to capitalize on them. It's a very top-down approach, and it informs everything they're doing. So how does that translate into an actual strategy? Well, here's the playbook. They're building these really niche ETFs tied to big themes, things like their WARE fund for defense and AI, or GAO for gold. They're calling this a Smart Beta 2.0 approach, basically using data to ride these big macro waves. To grow, they're looking abroad, expanding to Mexico and Colombia. And to keep investors from bailing during this rough patch, they're paying out a monthly dividend and buying back stock. This is their whole argument. Okay, so you have the ugly numbers and you have the hopeful narrative for management. Which one is the market paying attention to? Well, the immediate reaction was pretty telling. The market's verdict came in fast. The stock dropped 2% right after the earnings call. Now, that's not a total disaster, but it is a very clear signal. It shows that investors heard both the bad numbers and the optimistic story, and they chose to trade on the hard numbers. And this isn't just a one-day blip either. When you zoom out and look at the past year, the underperformance is just stark. GOAU is down over 5%, while the broader financial sector is up almost 19%. A gap that wide tells you this isn't a new problem. The market's been skeptical for a while now. This slide really just boils the whole conflict down perfectly. You've got management talking about their story, innovation, big ideas, shareholder returns. But the market is focused on the reality, a business model that's bleeding assets, posting losses, and getting left in the dust by the rest of the sector. Right now, they're speaking two completely different languages. So what could actually change this dynamic? What could get things moving again? Let's break down the bull case versus the bear case for U.S. global investors as we look ahead.
All right, so the bull case, it really hinges on a big comeback in fund flows. If their main airline ETF, JETS, or their gold fund, GOAU, can start pulling in assets again, that would directly fix the revenue problem. If their new international listings get some traction, that would help too. And of course, strong macro trends like high gold prices or more defense spending are direct tailwinds for their products. You add in some seasonal strength for airlines and the safety net from their buyback program, and yeah, you can start to build an optimistic case.
But, and this is a big but, the headwinds are substantial. This company is incredibly sensitive to market sentiment. Even the CEO admitted there's been apathy for their key investment themes. On top of that, it's a thinly traded microcap stock in a brutally competitive ETF industry. It all comes down to one thing. Without a rebound in AUM, the path back to profitability looks incredibly difficult.
All right, so we've laid out the numbers, the narrative, the risks, the potential rewards. So here at Talk Tickers, here is our final call on GOAU.
We're initiating our coverage with a market perform rating. Look, the strategy, the pivot towards these niche macro-driven ETFs, it's logical, it makes sense, and it's different. But the headwinds from declining AUM right now are just too strong to ignore. Until we see a real sustained turnaround in those fund flows, we think market skepticism is going to keep this stock stuck in a pretty tight trading range, which we see as between 2.25 and 275 for the next quarter. So with a neutral rating like market perform, you're probably thinking a long-term investment is a tough sell right now. And you'd be right. But the stock's really unique situation, that thin trading volume and its high sensitivity to news, it does open the door for a very specific tactical kind of trade. Okay, so here's our outrageous but plausible trade idea. The setup is the exact conflict we've been talking about this whole time. The thesis is this. Because the stock is so thinly traded, meaning not a lot of shares trade hands every day, any big positive news, say a geopolitical event that suddenly drives huge inflows into their war defense ETF, could cause a massive, rapid spike in the stock price. So the trade isn't to buy the stock and wait. Instead, it's to use near-term, slightly out-of-the-money call options as a low-cost way to bet on that potential pop. It's a high-risk, high-reward play on a sudden, sharp shift in the story. So there you have it, the full breakdown on U.S. global investors, a company really caught between a tough reality and a very ambitious plan. As always, this content is for informational purposes only and is not financial advice.